Welcome to Commercial Real Estate Pro Network's CRE PN Radio. Thanks for joining us. My name is J. Darren Gross. This is the podcast focused on commercial real estate investment and risk management strategies. Weekly, we have conversations with commercial real estate investors and professionals who provide their experience and insight to help you grow your real estate portfolio. Today's program is sponsored by Building Insurance and Risk. Don't put your real estate investment at risk. Work with Building Insurance and Risk and receive multiple coverage offers with a side-by-side coverage comparison. To learn more, go to buildinginsurancerisk.com. Today, my guest is Dave Dubeau. Dave Dubeau is a real estate entrepreneur, best-selling author, speaker, and investor attraction expert. And in just a minute, we're going to speak with Dave about raising capital. But first, a quick reminder, if you like our show, CRE PN Radio, there are a couple things you can do to help us out. You can like, share, and subscribe. And as always, we encourage you to leave a comment. We love to hear from our listeners. Also, if you want to see how handsome our guests are, please go to our YouTube channel. You can find us on YouTube at Commercial Real Estate Pro Network. And while you're there, please subscribe. With that, I want to welcome my guest, Dave Dubeau. Welcome back to CRE PN Radio.
Darren, thanks so much for having me.
Well, I'm looking forward to our conversation today. But before we get started, if you could take just a minute and share with the listeners a little bit about your background.
Sure. Well, thank you very much. I am originally from northern British Columbia, Canada, born and raised, living there now. However, I took a little hiatus and I lived overseas for almost 14 years. Traveling around Mexico and Latin America, settled down and lived in San Jose, Costa Rica for a decade, from about 93 to 2003, ran a language training company down there, got married, had kids, all that kind of good stuff. And then in 2003, I uprooted my Costa Rican family and moved us all back to the frozen hinterlands of British Columbia, Canada. And a lot of people, especially Canadians, go, "What are you, crazy?" Maybe. Costa Rica is wonderful. It's beautiful. However, being the pasty-faced white guy that I am, whether you have money or not, people assume that you do in Latin America. And there's a distinct risk of being kidnapped, held for ransom, that sort of thing. So in the small town we live in British Columbia, Canada, that hardly ever happens, right? So it was a matter of our kids were getting towards school age. We decided, hey, you know what? Costa Rica is great, but I think it would be better for the kids to grow up in North America. So that's why we moved back. So at that point, Darren was like, okay, now what do I do? I mean, I've been out of the country for so long. I didn't have a bad credit rating. I had zero credit rating, just nothing. I had been self-employed for quite a while, so I was pretty much unemployable. Hadn't been able to sell my business in Costa Rica, so I didn't have a lot of money to get started with. And it was a question of, what am I going to do? So I don't know if you remember those. You remember those late night infomercials, Darren?
Oh, yeah.
You too can get rich in real estate with little or no money down. I need you to do it. You've got the radio voice, but you know what I'm talking about, right?
Oh, yeah.
So I saw one of those commercials. I said, perfect. That's what I got. Little or no money. So I sent away for this program, a guy named Ron LeGrand, all about creative real estate type deals. I had to kind of Canadianize it. It's basically all the same stuff, Darren. I mean, we have slightly different language for things up here, but real estate works the same as it does in the States. So first little kick of the can was I did 18 deals in 18 months, these creative, low money, no money down type deals, which may or may not sound impressive. It sounds kind of impressive. However, you got to see some of those deals. Some of those were pretty sketchy at best. I'm talking about rundown mobile homes and mobile home parks and things like that. So, but I got very good at doing creative deals and attracting motivated sellers. So that's how I got started in the real estate space.
Well, 18 deals in 18 months. I mean, you're getting reps and you're having success regardless of, how pretty they were or how big they were.
Mm-hmm.
I would think that just, it's like anything, whether you're doing math or trying to learn how to hit a golf ball or whatever. The
Neither
repetition
which
is
of neither one of those things I'm particularly good at, Darren. So thanks
right.
for
But no, but the point is that repetition is really that's the key to it,
exactly, exactly,
or those that have some, natural talent. But even that, if there's room for improvement, and
definitely.
repetition is how you get there. So that's great. So you started. I know down here it seems like the guy was Carlton Sheets, but it was all the same kind of thing. It was a
Yeah,
late night. You knew it was time to go to bed when the ads started coming on because everything sounded too good.
yeah.
And
But I think I was stressed out. I had insomnia, so I was up late, thinking, what the heck am I going to do to put the food on the table, kind of thing. So
oh
that
yeah, no, I know I've got several insurance clients
no,
that I think that's kind of how they got started, because I remember some of the deals that they were bringing me when I first started doing insurance were like, God, it just they were nothing like anything I'd ever seen before. Trees growing through the chimney or
uh,
kind of thing, but they were making money and making it happen. And again, it was kind of more of an umption and finding those that where there was some opportunity, and then
right,
kind of learning the ins and outs and becoming more proficient. And to this day, they've done very well, and have multiple properties, a very secure um, you know base of equity and options for exits and all that fun stuff. So no,
exactly.
it's
I wish I had been smart enough to hold on to a bunch of those properties, but those were all kind of quick turn transactional type deals. So it made a quick pop of cash with them, but it didn't get any of the long term growth. So that was kind of dumb.
well, but during your experience though, you mentioned that you attracted investors and stuff, and
Well, yeah. So that's how I got started in real estate. Took a few years off, and then when I got back into it, then I started doing a little bit more traditional type stuff, starting with single family homes, buying and holding them for a while. That's when I started bringing on joint venture partners, investors, that sort of thing. Then transitioned into multifamily buildings later on. And these days, I'm more of a kind of a passive investor myself because, quite frankly, Darren, I realized a while ago I kind of suck at dealing with tenants and toilets. So I'd rather let the guys and gals that are good at that take care of that stuff.
yeah, no, that's an important realization to have. The property management versus asset management's two entirely different roles in
Exactly.
the deal there. But so let me ask you. So you came back into it. You got into larger properties and raising money.
Yeah.
Um, did you find the property first, or did you find the money first when you were doing these larger deals?
Oh, well, yeah, that's a good question. So at first, when I first started realizing I needed to access other people's money to grow my portfolio, I bought into the guru talk of just find a good deal and the money will magically find you. And personally, Darren, I'd like to find whoever came up with that expression first and smack them right upside the head, because I think they've done the vast majority of real estate investors a great disservice with that because it's baloney, at least in my experience. So that's what I tried at first. I remember it vividly. I had this little deal on the go, just a single family home, but I needed to raise $85,000, and I had less than 2 weeks to do that, and I didn't have anything lined up. So I was starting from scratch. So I'd heard that expression, find a good deal, the money's going to find you, but I knew that it wasn't just like the secret that the universe is going to plunk a bag full of money down on my patio. So I'd have to do something. So I'd also heard these gurus say, well, hey, you know what? If you need to raise some capital quickly, pick up the phone and do what all of us love doing, which is cold calling, right? Darren, I don't know if back in the day when you were first starting in the insurance business, you were encouraged to cold call people and try to pitch them on your stuff, but that's kind of a common thing for people in those kind of industries to be told. So I thought, hey, well, I'll give that a try. And I failed miserably at that. First of all,
Desperation. Yeah.
yeah, I didn't really know what I was doing. Plus, quite frankly, um, I just think it's really a really bad idea unless you've got an amazing sales background. You're very good at that. But if you're trying to raise, at that time, I was trying to raise $85,000. If you're trying to get somebody to invest 85 grand with you, calling them up cold over the phone probably isn't the best way to do it. So I did a bunch of those calls. That didn't work for me. So then I thought, well, I got to try something else. And I'd also heard, hey, go out and network up a storm, turn every conversation into a real estate conversation. Nothing wrong with networking, Darren. The challenge is when you're on a really tight timeline. So by this time, I'm down to like 7 days that I've got to come up with 85 grand. So when you're in a tight timeline and you're networking and schmoozing to raise capital, the desperation kind of oozes out of every pore in your body.
Right. Right.
Right? People can pick up on that. So it doesn't really matter how good the deal is. If you're coming across as desperate and needy, that's going to creep people out. It's just going to kind of repel them. So that's what happened there. And then I was getting really desperate a few days before I needed to close on this deal. I came up with what I thought was a great, brilliant idea. I said, hey, this is such a good deal. It'll sell itself if enough people see it. Have you ever heard anybody say something like that?
Oh,
Well, that
sure.
was me. So I put together a little one-page PDF outline of the deal, put together a list of a couple of hundred people that I knew, and I emailed them all this PDF. And I remember it was like a Wednesday night. I think I had to remove subjects on Friday. So it was a Wednesday night. I sent this out. Thursday morning, I got up. I was so excited, Darren, because I had some responses in my inbox. And then I started reading the responses, and they pretty much all said something along the lines of, hey, Dave, dude, I haven't heard from you in forever. One guy hadn't heard from me in 18 years, Darren. This was the first thing that showed up on his inbox from me. Hey, it's Dave. I got the deal. Have you got the dough? Kind of thing, right? And they all basically said, hey, Dubeau, take a long walk off a short deck, take a hike, get out of here. Bottom line, Darren, that's a very long-winded way to say I lost that deal. I was not able to raise the money for it because I'd bought into that. Find a good deal. The money will find you. Since then, I've completely changed my philosophy. And I think, hey, here's the goal. Get your investor ducks in a row first, and then go looking for the deals. Or at the very minimum, do both at the same time. But don't wait until you got a hot deal on the go and then desperately start looking for the capital. Try and get
Right.
that set up ahead of time, get those investor ducks in a row. So the whole goal, and nowadays we work with clients and we help them do all of this stuff, is we want to get you a bunch of investors waiting in the wings, anxiously, biting their fingernails, waiting to jump in on your next opportunity. So that's the goal these days.
So you now, do you still raise money for your own deals, or do you primarily work with others to help them raise money?
Primarily these days, I'm working with others. We have kind of, for the lack of a better term, a boutique marketing agency, and we work with what I call mom and pop real estate investors, help them get started on their path to raising capital, doing it the right way, and help them get their first, anywhere between 500,000 to 1.5, maybe $2 million worth of investors and capital lined up. That's the goal.
Oh, that's impressive. So in that role, what are some of the mistakes you see that, or people that are trying to raise money make?
Yeah, well, everything that I just mentioned, all those mistakes I made, I see other people making those as well. So waiting until you've got a deal, until you start trying to raise capital, and then just floundering around and running around like a mad person, that's a big mistake. Another big mistake is, especially for newer capital raisers, is they think that everybody and anybody with a pulse and a checkbook could be a good investor. So I'm going to cover my butt here, Darren. I'm going to say the caveat is I'm not a lawyer nor a securities specialist. I'm a real estate guy up here in Canada. However, you guys in the States have the Securities and Exchange Commission. We've got our own version of that up here. They're just as nasty. It's all basically the same rules. So same idea. So a lot of people, and I'm sure you've seen this as well, they start pitching their deals on social media. Like they put it up on Facebook or LinkedIn or whatever their flavor of social media is, and say, hey, I'm looking for investors for this deal. I'm offering X, worse yet, guaranteed, and all this kind of stuff, right? And they're trying to solicit investors in a public forum. And my understanding is that is illegal, right? Unless you're licensed to do so. Like if you're a stockbroker, if you're a financial planner, certain cases, maybe a mortgage broker, certain financial specialists, they can do that. They're able to do that. The big banks, etc. Or if you're set up with a specific exemption, in the case of our American friends, right? You got exemptions, or you're set up with corporate structures and offering memorandums and all these kind of things, which tend to be very, very expensive and cumbersome to set up, which doesn't really make a lot of sense if you're doing a little single family home or a duplex or a small deal, right? So where does that leave us? Well, I think the best place for people to start is to focus on their existing network of contacts. So instead of going out to everybody and anybody, I mean, we got to be logical about this as well, Darren. So, I mean, think about it. If you're trying to get somebody to invest $50, $75, $100,000 or more with you in a deal, chances are they're going to need to know you, they're going to need to like you, and they're going to need to trust you with their money. If you're going out to the great unwashed masses, you're going out to the general public, you're going out to strangers. Strangers don't know you, they don't like you, and they certainly do not trust you with their 100 grand. So that's a long shot at best. So why not focus on where we can kind of shoot fish in a barrel? And that's with people that you already have in your existing network. Friends, family members, coworkers, business associates, people who know you and who you know. Because when we focus on those folks, number one, we've taken care of the know, like, and to a certain extent, the trust factor. They know you, they like you, they may trust you to babysit the dog for the weekend, maybe not with 100 grand yet, but we're getting closer. We got 2 out of the 3, which Meatloaf sang a song about that. That ain't bad. That's a good place to start, right?
Right.
So that's what we recommend is when you're getting started with raising capital, focus on your existing network, laser focus on that. It's going to be the fastest capital. It's going to be the easiest capital. And it's going to be the safest capital for you to get started with.
That's good. With raising money, I guess that you mentioned like when to start. You recommend kind of either before or at least at the same time when you find a deal.
Well, yeah, I recommend before.
Okay.
So that's a really good question, Derek, because a lot of people are hung up about this, especially when they're first starting with a raise capital. When should I start trying to bring on joint venture partners, investors, etc.? And my personal opinion is, as soon as you've got one successful deal under your belt, then you are ready to start using other people's money. Because the statistic I've heard thrown around for years is that 95% of the general population has never purchased an investment property before. Their own house does not count as an investment property. So if you've got even one successful deal under your belt, chances are you're ahead of the vast majority of the non-real estate people that are in your network. So, and my philosophy is, a good real estate deal is the absolute best way for everyday folks like your listeners, myself, our investors to get an above average return on their money backed by a solid tangible asset, a real piece of property. Because I don't know any other investment class out there that we can exercise as much control over, right? So when you think about it, a piece of property, we can control what market we want to focus on, what kind of properties we want to focus on, who's selling them, on market, off market type deals, to a certain degree, how much we pay for them. There's a little bit of negotiation available there, how we get them financed to a certain degree, right? We can control what we do with those properties once we get them, how we make improvements on them, who we put in those properties as our tenants, if we're holding them long-term, how we exit those properties. So we have so much more control over this asset class than buying gold, stocks, bonds, mutual funds, crypto, all these kind of things. We really don't have much control over, right?
Right. So as far as the asset goes, do you typically work with people that are looking for like multifamily value add, or do you work with other asset classes or other strategies for buy and hold, or what's kind of the sweet spot?
Pretty much, as far as the people that we work with as our clients,
yeah,
pretty much runs the gamut there, Darren. So again, we tend to be working with smaller mom and pop real estate investors. We're not working with the big time syndicators. So we've got clients who are doing single family homes, burrs, self-storage facilities, buy, fix, and sell flips, small multifamily properties. We've got people that are doing land deals. We've got people that are doing car washes. We've got all, pretty much commercial, you name it. If it's got real estate involved with it, the process works the same way. Tax liens, tax deeds too. Yeah.
Got it. So, how do you set realistic or attainable expectations when you're meeting with somebody? Is it based on the size of the network that they have, or is it their experience, or how do you kind of if I came to you and said, Dave, I want to raise $10 million,
Well, I would say that's great, Darren. How much have you raised to date? And if you say a
yeah,
big fat
I've,
zero,
right,
then
yeah,
then we'll say nothing wrong with wanting to raise 10 million. We can probably help you get up to your first 1, maybe to 2 million by really leveraging your existing network, because that's what we found over the last 6 years we've been doing this, is we can typically squeeze the juice out of your existing network, get that 1 to 2 million out of there. Once you've got that, then you've got to quickly work on expanding your network and probably start working with accredited investors who have larger amounts to invest there. But that's kind of why that's our sweet spot, is we help people get started in the process, get them up to that, over time, up to that 1 to 2 million.
got it. And even in that, it just occurred to me, like I'm assuming that there's kind of a reality check sometimes based on what people want to do versus what seems reasonable or what's easily attainable. And the
Yeah.
first thing, do you find that kind of the eyes are bigger than the plate kind of thing, or what?
Well, not necessarily. There's a bit of a range there, but quite often, Darren, again, like I say, we're working with the mom and pops that have been doing some deals for a while. That typically they self-finance their first 2, 3, 4 properties, something like that. Now they've hit the wall, they've run out of cash, they've run out of credit. They tend to be very insecure about how to go about raising capital. So if anything, a lot of them tend to be quite conservative, right? So we actually are able to show them that, hey, we can probably get you even better results than you're hoping for. But again, yeah, it's important that we have those realistic expectations. So typically what we say is, hey, it's fairly straightforward to raise your first 6 figures in a matter of, less than 2 months kind of thing. And then we can be working you towards the 7 figures, the $1 million mark, over the course of a year. So it's not a immediate type thing. So it's like anything. I mean, Darren, you've been in the insurance business for many years now. So you understand that, when you first reach out to that target group, that market, you're going to have some low hanging fruit. You're going to have some people that are ready, willing, and able to do business with you right away. But then you're going to have a much, much larger group of people. They're going to take a little bit of time to warm up to the idea. They're going to take a little bit of time to be convinced that you're the real deal. It's going to take them a little bit of time for them to be ready, willing, and able, especially in our case, if we're trying to get them to invest 50, 75, 100 grand or more, they're going to have to feel very, very comfortable. So we're going to have to work on their time frame, not just our time frame. Does that make sense, Darren?
Yeah, totally. You mentioned kind of the lack of confidence, or I don't remember exactly how you said it, but something about the investor not really. I took it to mean like they didn't really believe in the value of their experience, kind
Yeah,
of thing.
so a lot of our work is just getting people in the right headspace to show them that, yeah, they are worthy. Because here's the thing, right? A lot of people are listening to smart guys like you with podcasts that are interviewing super successful real estate investors who've got dozens or hundreds or thousands of deals under their belt. They're watching guys like Cardone on YouTube with, raising gazillions of dollars and all this kind of stuff. That's what they think is normal. But that isn't what's normal, right? Normal is mom and pop real estate investors. That makes up over 80% of the population of real estate investors. And the reality is the vast majority of the people in your network could really benefit from partnering with you on a deal. I mean, we talked about we talked about real estate as an asset. And if you look at the kind of returns, and I know you're in the financial business, Darren, so you see this every day, right? The kind of returns the average person is getting on their investments, whether that's stocks or bonds or mutual funds or whatever it is pitiful. It's not even coming close to keeping up with inflation, especially these days. They're getting whacked with fees left, right, and center by their financial planners, and they really aren't coming ahead, getting ahead by doing it the way we're told to do it, right? So when we bring people the opportunity, when we educate people about what we're up to with real estate investing, and I say educate, that's a very purposeful expression there. I'm not saying pressure, I'm not saying manipulate, I'm not saying convince people to invest with you. When we show them what we're doing, we show them what's in it for them. We show them the big benefits of real estate, not only as an investment class, but also all the multiple ways that they can profit from even one real estate deal. So, Darren, I know you will work with a lot of guys and gals in the commercial space. So if we're talking about, for example, an apartment building, I'm aware of up to 8 different profit centers from one multifamily deal. Now, compare and contrast that to almost any other investment out there that might have usually just have one way to make money, maybe 2, but definitely not 8. So again, when we're able to show people, hey, here's why real estate rocks and why it's so much more, is so much superior to pretty much everything else out there. And we allow them, we show them the pros, we also show them the pitfalls, we show them the risks as well, and we allow them to make an educated decision.
Got it. So when you have somebody and you said kind of work with them on their own mental frame of mind, to kind of get them to know that they do have valuable experience and others would like to probably work with them.
Yeah.
Is it kind of from that point, is it stories that they kind of, learn to tell others about, their own experience? Is there a medium that you find works best? Is it written letters? Is it emails? Is it phone calls? Is it what's kind of the method and then the frequency that you find that somebody is getting started and trying to raise money? And let's say they've been investing for years, but all solo.
Also, that's very common.
And now they're looking to try and raise some capital.
Yeah, that's a really good question, Darren. So what I talk about are the 3 C's of capital marketing. And the 3 C's are constant, consistent, edutaining communication. Sorry, I had to throw edutaining in there. I'll explain that. Right. The constant, consistent communication. Communication's the marketing. It's what we're saying. Constant means the frequency. So our recommended frequency is like once a week. That's pretty ideal. And once a week isn't overwhelming. I'm sure you're on a bunch of different people's email lists and you get gazillions of emails from certain people, way more than once a week. So once a week isn't overwhelming. And we recommend that people mix it up a little bit. So the simplest things to do, and the things that are most effective these days, are electronic newsletters. So for example, once a month, when we're working with clients, the first week of the month, we send out an electronic newsletter on their behalf, and we try to make it edutaining. What does edutaining mean? It means a little bit educational, and hopefully a little bit entertaining without necessarily being goofy, right? So here's what we need to remember, Darren, and this is true of any business, right? You're in the insurance business. And what you probably learned a long time ago is that you are very enthusiastic and keen about insurance, yet very few other people are. No offense, but
very true.
Very true. Same thing with us as real estate investors. We're nerding out on this stuff. I mean, for crying out loud, you got people listening to us jabber on about real estate investing and raising capital. You got to be a little bit different than the average person if this is something of interest to you, right? And that's a good thing. But what we got to remember is our target group of potential investors are not us, right? They don't really give a darn. They want to know that we know our stuff and they just kind of want to get the gist. So a big mistake I see a lot of people making is they try to over educate their prospective investors by doing a data dump of everything in their brain and try to transpose it onto other people's brain. Big mistake. So we want to keep it super simple, educate them a little bit, hopefully entertain them a little bit, and keep it super simple. I call it Reader's Digest level. You remember the good old Reader's Digest, Derek?
Oh yeah. No,
Yeah.
yeah.
My grandma used to get that. I used to read that when I was a kid at her place. It was great. So it was a magazine written for grown-ups. However, it was written at a 13-year-old reading comprehension level. So we want to keep I'm not saying our investors are dumb. We just want to keep it super simple for them so it's easy for them to consume and understand and have a clear call to action. So to answer your question, this is a long-winded answer for sure. What are we recommending? Electronic newsletters. Then we'll follow up the next week. It might be a blog post, so a short little article, something about why real estate rocks compared to everything else, or why the specific strategy you're focusing on or the market you're on. Pretty light, not too heavy, with a clear call to action. Hey, if you'd like to find out more, click here, book a call. Let's have a conversation, see how this could work for you. The next week, it might be something different. Perhaps it's a short video, a video log, a vlog. And that would be like a 3 to 5 minute little video where you're talking about something, maybe sharing a story, sharing a case study, doing a walkthrough, showing before and after pictures, something like that. So again, keeping it fairly high level, hopefully a little bit entertaining, and then with that clear call to action. So every single week, drip, 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 something to get top of mind and stay top of mind with your prospective investors. The low-hanging fruit, they're going to be keen. They're going to be responding right away. The other folks that take a while, hey, they'll respond when time and circumstances are right for them, right? So it might be 3 months down the road, 5 months, 6 months, 12 months, 18 months down the road, really doesn't matter, right? Because if you're doing this constantly and consistently, it's going to be creating a regular flow of investor meetings for you. And that's the whole goal.
No, that's really good. The kind of the frequency and the method and again, I think myself, I know I struggle with that kind of I feel like it's kind of horn tooting. It's always like, look at me, kind of thing.
Well, yeah, that's a good point, right? So you sound like you're kind of a conservative kind of guy, and most of our people are as well. They don't want to come across like a Grant Cardone. Nothing against Grant, but he's over the top.
No,
right?
but yeah, I mean, it's just it's a level of comfort and confidence in what you're doing, and that people, I mean, there's the number of messages, and we're all bombarded by information.
Yeah.
And I think one of the challenges that's tough to keep in mind is that, yeah, we are bombarded by stuff, but there are people that know and like you already, would love to hear more from you about whatever you're doing, especially if it's something positive and it's you're genuine. I think the authentic piece is really critical to that. I've had numerous instances where people have come across way over the top, way over their skis, kind of thing. It's like,
turns you off, right?
Yeah, just it's not genuine. Or if it is genuine, that's not the person I want to, that's not the one I want to get to know more. But
exactly. And that's why we call this, if we go about it this way, it's not exactly like shooting fish in a barrel, but it's the closest thing we can get to it, because again, you've already got a connection with these people. They already know you. They already like you. That's why you can be genuine. And to get to your point about how to do this without being all, hey, look at me. What we do with our clients is we really try to keep it focused around communicate what's in it for the other person, right? We've all heard the WIIFM, right? So let's focus on when you're telling a story, especially if you've worked with a joint venture partner on a deal or something like that, then talk about it from the aspect of how they benefited. Here's what our investors loved about this. Here's how our investors and ourselves benefited from this. So when you're using that language, it's not all about, hey, here's how smart I am, here's how clever I am. It's here's how we did this together and we benefited together.
No, No, it's definitely a powerful message and an opportunity for anybody that's especially anybody that has invested and is looking to grow to the next level, and looking for ways to raise capital, because I think it is, there's mindsets, and I know I kind of share a little bit of that. It's like, well, if I do it myself, then I don't have to like worry about engaging others, kind of thing. But the reality of that is that when you think that way, you cap your ability to grow, uh, your asset base and your wealth, and also to share it with others. I mean, there's nothing like you're saying, when you're excited about something, um, it's contagious.
Yeah.
And when you share that, people go like, wow, that sounds pretty good. And tell me more. How do I get in? Kind of thing. I think that's kind of a common thing. Well, how can I get in?
Yeah.
And definitely with the market being what it is, there's people looking for, um, ways to improve their returns, and definitely they likely don't know all the ins and outs or the benefits of real estate. And here's your chance to educate them and attract some of their money, and or attract them to it, and grow and grow for you and for them. So I think it's a great
It's
idea.
it's kind of like, in a certain way, it's kind of like the insurance business, Darren. And correct me if I'm wrong, because I'm not in the insurance business, so I'm making some assumptions here. But I feel like we owe it to people to show them what we're up to and allow them to make up their own minds as to whether or not they'd like to get involved. So, like with insurance, I'm sure you feel this way, that you would be doing people a disservice if you didn't at least allow them to be aware of what it's all about and what the big benefits and how it can protect them. Well, the same idea with a real estate deal, when we're not trying to push our stuff on people, we're just trying to educate them about what we're up to and how we can compare and contrast that to their other options. So same kind of idea when you're doing insurance, right? Having insurance versus not having insurance, or having a certain kind versus another kind. You understand the intricacies. Now it's up to you to be able to explain that at a level that people can really understand it and get what's in it for them.
And to that, I think that if you don't share that information with others, and they hear it from somebody else, and they act with that other person because you didn't introduce it to them when you were doing it, I think that's the thing that's kind of a driving motivation,
That's a
kind
bit
of,
of a punch in the guts, isn't it?
yeah.
Yeah.
I mean, because multiple times, I think we all kind of qualify somebody without ever introducing the topic or whatever, or gauging kind of where they're at, and
Mm.
we just assume that they're probably not there. And it's a great disservice to the other party. It's a great disservice to yourself. And the reality is if if they know that you're in this, and say they do hear about it from somebody else, but they know you,
Mhm.
uh, chances are they would come back to you first to at least find out more and see if that's something that fits with what they're doing, and or
And
what they want to do.
that's why what you do is so important, is right, is because I'm sure for your business, you're doing the podcast, you're doing a great job of staying top of mind and having that constant, consistent, edutaining communication. You're doing that every time you do a podcast episode. So same idea for us when we're raising capital. We got to make people aware of what we're up to. So get top of mind and then do our best to stay there. So when time and circumstances are right for them, we're the ones they're going to think of.
No, that's the plan. That's the strategy. So hopefully it all
Excellent.
stays on course.
I'm sure it will.
But hey, Dave, if we could, I'd like to shift gears here for a second.
Okay.
As we've discussed, by day I'm an insurance broker, and I work with my clients to assess the risk they have and determine what to do with it. And there's three strategies that we typically consider. We first look to see if we can avoid the risk. When we cannot avoid it, we look to see if there's a way we can minimize the risk. And when we cannot avoid nor minimize the risk, we look to see if there's a way we can transfer the risk.
Hmm.
And that's what an insurance policy is a risk transfer vehicle. And as such, I like to ask my guests if they can look at their own situation Could be their clients, investors, tenants, the market, interest rates, political climate, geopolitical climate. But take a look at your situation and identify what you consider to be the biggest risk. And again, for clarification, while I am an insurance broker, I'm not necessarily looking for an insurance related answer.
Mhm.
And
Good, because I'm not going to give you one.
good, good. So Dave Dubeau, what is the biggest risk?
The biggest risk in my mind for real estate investors is relying solely on their own financial wherewithal to create their portfolio. So this might sound self-serving because I'm in the business of helping people to raise capital, and maybe it is, but that's what I focus on. So just like you focus on insurance. So I see so many people get stuck and stay stuck with a real estate portfolio that just doesn't really do much for them because they don't know how, or they're not willing to grow using other people's money. So they stay stuck with 1 or 2 or 3 properties in their portfolio, which is better than nothing for sure, but it's not going to allow them to create that real estate dream they had in the first place, which is usually to create enough passive income to be able to quit the job, right? Or to be able to retire earlier or whatever it is. So that is the biggest risk, is just staying stuck because you're not willing to expand by partnering up with other people.
No, you got to stretch, got to get out there and stretch and make it work for you and others. That's good.
Exactly.
Dave, I cannot say thanks enough for taking the time to talk today. Before we wrap up, where can listeners go if they would like to learn more or connect with you?
Oh, thanks so much, Darren. I appreciate being on the show as well. So I'm really excited because we're just launching a brand new podcast all about this stuff, all about helping mom and pops get started on their path to raising capital. It's called the How to Raise Capital 101 Show for real estate investors. So you can find that wherever you enjoy listening to podcasts, the How to Raise Capital 101 Show, or you can check it out at our website, raisecapital101show.com. And again, Darren, the whole goal there is to, actually the first 9 episodes are going to be a little mini course on what I call my money partner formula. And it's all about how to raise your first 6 figures in a matter of weeks and 7 figures in a matter of months, even if you're starting from scratch and you've never raised capital before. So again, that's the How to Raise Capital 101 Show.
Awesome. Well, Dave, again, I can't say thanks enough for taking the time to talk. I've enjoyed it, learned a lot, and look forward to doing it again soon.
I appreciate it so much. Keep doing what you're doing, Darren.
All right, Dave, thanks. For our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.